but yes, we show people how to do something as simple as buy a first mortgage on somebody's house where a real estate investor has sold it, owner financed it. We've vetted the loan, put it through a process, and teach people how to do that. We bought 50,000 of them, so we have a fairly good sense of kind of like what the risk management profile looks like. And we have found that compared to a rent house, for example, right? And I know you have a commercial real estate podcast, but just something simple and easy. Compared to a rent house, most note purchases have two and a half or three times the income.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Eddie Speed. Eddie Speed is the founder of Note School. And in just a minute, we're going to speak with Eddie Speed about opportunities in private note investing. But first, a quick reminder. If you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Eddie Speed. Welcome to CREPN Radio.
Thank you very much. I'm glad to be here.
Well, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Well, I'm a specialist in real estate, and I've been involved in real estate, but I'm a specialist in really an ancillary side of real estate, which is note buying. And I've been doing that since 1980. So this is my 45th year in the business. And about 20 something years ago, 25 years ago, I actually formed a school teaching people how to buy notes because I found out when we could teach them more about it, then it made more sense to them and they could make safer decisions and make confident decisions. And so we formed a school about 25 years ago called Note School. And we teach basically real estate investors how to add buying notes to your strategy.
Got it. So when you say notes, are we talking about bank loans? Are we talking about private notes? Are we talking about any and all existing notes? And I mean, in a note, just to be clear, we're talking about something that's been recorded against the property. Is that right?
It's a first mortgage on real estate.
Okay.
So you'd be the bank, you'd own a first mortgage. The market cycles. So over the past 45 years, we bought notes on, from RTC, we bought notes from failed banks, and we bought lots of seller finance notes. I bought over 50,000 seller finance notes. So that's clearly a specialty that we have. And right now we have found that the biggest market opportunity at the moment are buying seller finance notes. There's a lot of delinquent mortgages. They haven't quite hit the market yet, but there's some crazy stuff happening. That we're finally seeing a notice of default turnover on several 100,000 residential mortgages. So that train is coming down the track, and we are prepared for it when it does. But but yes, we show people how to do something as simple as buy a first mortgage on somebody's house where a real estate investor has sold it, owner financed it. We've vetted the loan, put it through a process, and teach people how to do that. Um, we bought 50,000 of them, so we have a fairly good sense of kind of like what the risk management profile looks like. And we have found that compared to a rent house, for example, right? And I know you have a commercial real estate podcast, but just something simple and easy. Compared to a rent house, most note purchases have two and a half or three times the income.
Interesting.
Go look at a rent house, right? The typical rent house, and and once again, you have an audience across the United States. So somebody in California versus somebody in Ohio has a little different number, right? But let's just take the average market. You used to buy a rent house and you get about an eight cap. Remember those days? You bought
Yep.
a house, you paid 100,000 bucks, and it threw off $8,000 net operating income per year before debt service. That was the cap rate, right? Now all of a sudden you take the identical house and it earns four cap. Same property, it just earns half the money,
Yep.
right? And so for those reasons, what if you can buy a note and earn 9 to 11?
Right. Right. So let's back up here a second. So you have notes. You mentioned the two sources that it sounds like are the primary sources are seller finance and then notes that are in default. Did I hear that
Yes,
right?
sir. Yes, sir.
Okay. And the notes in default, the cycle on that makes sense. Economic times get tough. People had borrowed money, aren't able to pay their mortgage. Um, are these are you like buying notes at auction? Are you coming in there before the property goes to auction? How Tell me a little bit about how you guys uh, or what the
So we
opportunity looks like there.
so first of all, let me be clear about this. There's not a
Uh,
giant supply of non-performing notes at the moment.
right.
What we've had in the residential market, and we're seeing commercial in the same space, there's been a big giant extend and pretend, right? The
Yeah.
average days delinquent, if you want a crazy statistic, the average days delinquent for the 300,000 loans in foreclosure today is 1,300 days.
Wow.
The average days delinquent for loans that are more than 120 days delinquent, but not in foreclosure. They're not even in foreclosure yet. The average days delinquent is almost 600 days. So, yes, we've had a giant extend and pretend program for the last 3 years.
So in that, I mean, those numbers you're talking 2 to 3 or shoot almost 4 years, are you not? With the you said 1,300 days on
The
the
average
one.
days in loan, the average days in loans in foreclosure today, 300,000 loans in foreclosure. Average days delinquent is 1,300 days. By the way, I sourced this from two different sources. First of all, ICE, which used to be Black Knight. And second of all, I'm good friends with Darren Bloomquist, who is the auction data guy for auction.com. Both of them have confirmed those numbers. So I know it sounds wild because it sounds wild to me, but what we've seen is, and now, with the new administration, this isn't a shocker. With the new administration, there seems to be a big shakeup in DC about all these loans that have not been progressed to some level of resolution. And so we know it's coming. We know that um, we know the first thing that's happened is they've put a moratorium on no more extensions um, and the Ginnie Mae product. And we feel like that's right where we're going to be with Fannie and Freddie. So it's gonna probably happen, and we're going to see a lot of activity. The banks are not going to foreclose; they're going to sell the loans prior to foreclosure. Right? You can
Right.
write that one on the wall. So there is a big inventory of non-performing notes coming. Typically, what we do is we're pretty connected in the space. So we have trade platforms and groups that we know extremely well. And they're looking for us to go stand up, capital and buy these loans. And then what we do in our school is we connect our students down the road as they progress with us with inventory. They have to know something before seeing inventory of notes makes sense. So there's two areas that we're very strong in. One of which is as there becomes availability of non-performing notes. I've been in this space for 45 years and I'm fairly connected with the platforms that have access to these notes. The next area is seller financing, and I bought 50,000 seller finance notes. So in that specialty industry, we would be an extremely recognizable name in the industry. So we work with real estate investors every day to basically help them create good notes that they can then sell through us in the secondary market. So we create a note manufacturing system for seller financing, and it becomes better grade of note than just some individual kind of making up the terms and then showing up and saying, hey, will you buy my note? Why don't we help you with how to make a good note? And that way we can predict the performance of that note better if we're involved in how they originate the note. So that's kind of what we do. There's a big void in the conventional financing market, as you well know. And that's when seller financing does good, is when conventional lending isn't doing good.
No, it makes sense to me. Uh, I guess I'm curious when you underwrite these because obviously the borrower and the lender, there was an underwriting process that took place in the beginning.
Yes, sir.
Clearly the repayment plan hasn't worked out as intended. The lender's been sitting on this loan. It's getting kind of, stinky kind of thing. I mean, they're at the point where they're going to have to act. When they're in we've got a loan that's non-performing, what describe what the opportunity looks like from a note investor standpoint.
Well, if you're buying a non-performing note, you're buying a note for two things to happen. Either you're going to get paid off or you're going to end up with a collateral, right? If
Hmm.
it's an equitable loan, in other words, if they owe 100 and the house is worth 200, then you're never going to end up with the property, right? You're going to get
Right.
it at prior to foreclosure or at foreclosure, you're going to get paid off. And by the way, we're not trying to buy it to go take their equity. We're just saying, we're buying a position in the loan that says something's got to happen. They've not had any pressure to date to go do something about it. That was somebody else's decision in the past. Like going forward, that's not good for the mortgage industry. And I think our administration is going to see that, right? So I'm not for this continuous extending these loans and not doing anything with them. I don't think you're doing the borrower a favor.
Yeah, no, it makes sense. So let me ask you. So if you come in and buy a non-performing note, is your remedy or does your intent usually involve foreclosure, or is it try and work with the borrower to see if they can get on a repayment plan, or is
They've
it
been trying to
to
modify this particular inventory. They've been trying to modify these loans for 4 years.
right?
So you can kind of assume that's a failed effort.
Got it.
I don't
Got it.
mean that you don't make an effort and you don't try to do that. I'm not saying, we're not going in there like vipers. We would love to
Right.
modify the loan. But when somebody is delinquent on their mortgage for 600 days, what's it going to take them to bring the loan current?
Yeah, they're not going to come in with a bag of cash and say, "Sorry, I was just waiting to figure this out."
And so modifications are less likely. Uh, and so then you're probably it's on a track to foreclose. And once again, you're hopefully you got if the borrower has equity, hopefully he's making the right decisions and going to sell the property and pay off the mortgage and all of a sudden end up with some equity and do good. If that's the case and it's and your payoff at foreclosure, your bid instructions they call it, to the attorney has is told how much your payoff is, if it's enough money, somebody's going to come in and buy it. And by the way, whoever buys it at foreclosure, anything above the payoff to the lender goes to the borrower. So,
Right.
so,
Right.
but hopefully the borrower makes a good decision and sells it ahead of time. If they're underwater, and now because of so much accrued interest, that's why I made the point of how long they are delinquent. You've got insurance and you got taxes and you got preservation and you got all these other things that have now added to the loan. So now all of a sudden that payoff of the loan has gone up quite a bit. And so now all of a sudden some people have their equity has eroded because of that. That's why I said it's not fair to the borrower to have allowed them to go that long. They've lost their equity.
Right.
And
Right.
but I didn't make the math, or I didn't cause any of it. I just bought a position in the deal, and that's where it is. So in that case, that case you foreclose and you end up with the property, and and it doesn't look anything like 2008, but it's going to be the biggest spike in the market that we've seen. People are freaking out a little bit about levels of inventory of real estate, both on the commercial side and on the resi side. Well, let me tell you something. If you add the delinquent loan pile to it, that shadow inventory looks bigger than people are talking about.
So let's walk through one of these. I just want to make sure I understand because I get the basics. Got a loan. So just for easy math, let's say it was $100,000 loan. And like you
Yeah.
said today, the property is worth 200,000. Um, the borrower paid on it for a little bit of time, but ended up in a bad situation, and now they haven't paid for the 1,300 days.
Yep.
And so the all of those payments, that interest that they've not paid is then accrued and is added onto the balance of that loan, correct?
Yes, sir.
So instead of it being a just under $100,000 loan, now it's probably 100 plus based on just all the interest
Yep.
and that. So if the property's worth two, the loan's worth, or the loan balance is one plus,
Yep.
what would you expect the lender who's got a non-performing loan be willing to offer that at? Are they going to offer it at what the balance is? Or I mean, I'm guessing that wouldn't, because like you just
No.
said, if the equity,
You're buying
the
a
equity,
problem.
yeah,
You're
right, right,
buying
right,
you're buying a problem, and if you're not going to get paid for it, the market's not going to pay for it. Let's
right.
just say the loan balance is 125,000,
Okay.
just to throw a number in the air,
Yep.
right?
Okay.
So the principal balance is 100, and there's $25,000 worth of accruals. That's probably about an average deal, right?
Okay.
And so we would probably pay anywhere from 90 to 100 grand.
Okay.
And
And
remember, the interest does still keep accruing until you get paid off. So from the day you buy it, it is still accruing interest. So the payoff is going to keep increasing until that day you get paid off.
right, 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 right. No, and I would assume then that your whatever the process is to confirm the situation and to see if it is a salvageable uh, reconstruct, or modify type
Mhm.
situation. Which clearly, if you're 4 years down the track, there's no coming back. Is kind of what I.
It seems unlikely.
Yeah, unless they stumble across a lottery ticket or um, a relative or something. Somehow they come into money.
Yeah.
But in that, what kind of timeline would you expect from you acquiring the note to reaching the point where let's go to foreclosure? Because the word foreclosure, it's a process. It's not a you know well, we're at foreclosure. How long are we talking between acquiring the note to say a liquidation and getting paid?
So it depends on what state you're in. About half the states have a shorter foreclosure process, and about half the states have a longer process. It depends on how the court system deals with it. if there's a set of statutes that allow you to foreclose without going to court, which is called a statutory foreclosure state, right? Then it's a shorter foreclosure. So call it 6 to 8 months. If it's a judicial foreclosure process, usually if they use a mortgage, it's a judicial process. If they use a deed of trust or a trust deed or a deed to secure debt, it's a statutory foreclosure process. So if they physically use a mortgage, it normally is a court process to foreclose. So that's going to be a longer process. Get the court involved, and and depending on kind of what the state's positions are. So you have certain areas of the country you kind of know are a little more liberal, and they're going to like, well, the borrower came in, he's 4 years delinquent, but he's just another 3 months, and he's going to get his life all squared away. I'm being a little sarcastic here, but
Right.
I've heard this happen, right?
Yep.
I've been to that rodeo, so, right?
Right.
But once again, here's the thing about it: when you buy that delinquent note, you are accruing interest. So
Right.
it's not like, even though you get a little bit irritated that they extended it, you are getting paid for it,
Right. Right.
right? And
Right.
so part of that due diligence and breaking it down is what's the as is value of the house? How long does it take to get to the collateral? How much additional money have I got to put into it? Paying the taxes, paying, whatever, homeowner association, paying insurance, whatever it is, that are additional costs over and above me just accruing interest. And all that just becomes really just a mathematical formula that you now develop a model, and you say, we want to pay this, and at the end we're going to get this much profit.
Got it.
And
Would you?
usually that to make that math work in the non-performing space, it's going to be a double digit yield for sure.
Got it. And for that, the distinguishing the two types, the statutory versus the judicial, would you expect a different rate of return between those two models?
Somewhat. Somewhat. Once again, you model it up front, so you know how long it is to resolution. I mean, this isn't like some giant mystery. We've got
Right.
indexes we can look at and tell you in any state what the average days to foreclose is, what the likelihood of bankruptcy and how that disrupts it. Like all of that's like not exactly going to the moon. And today with technology, we have so much information that allows us to underwrite. Not like when you and I were young puppies and we were having to throw a dart a lot closer, right?
Right. Right.
And so there's efficiencies today, and there's vendors that can do due diligence for you that is amazing. Like we've got vendors that we can hire that can do the due diligence for you, and they are the same guys that do due diligence for hedge funds. Now, most individuals wouldn't have access to that kind of a person, but I do because I've been in the business for 45 years, and that's why I have a school is I help people connect them to information that's valuable to them.
Yeah. No, absolutely. It's one thing to go out and figure it all out, but to shorten the learning curve and to have success, that's worth a lot.
And you don't have to go stand up a business. You're hiring a vendor that has stood up a business, and they're doing that, and you're reading the report.
Right. Right.
Theoretically, you could do your own property inspections,
Right.
right? You could go Google enough research, and here's how you test this, and here's how you test that. How long would that take you to go do your own property inspections?
Longer than it would to call a guy and pay a guy. Uh,
Exactly.
yeah. Yeah. So the timeline we talked about from acquiring to foreclosure, getting paid kind of thing. Um, what about you get the list? You mentioned you have access to these pools of mortgages. Is a student or a note buyer able to pick and choose notes, or is it like here's 10, you have to buy the whole thing, or how does that work?
Usually, if we've broken it down, we have some kind of a capital source that is in a position that would move them on a one-off basis. So usually we know that not necessarily every student. Listen, I have people come to note school sitting on $5 million in cash, right? And they're in a position to make a decent trade and a pretty good size little thing. And then I've got note school students that are sitting on $250,000 in cash, right? So you have to have inventory that matches their cash availability. Cash
Right.
availability is not necessarily money in your checking account. It may be capital you can source that may not be just sitting in cash, but it's a way that you can get it to cash pretty quickly.
So the sources of cash, is it typically retirement accounts or self-directed IRAs or what?
I would say that I've done more training for self-directed IRA companies than just about any guy in the industry. I probably taught for at least 25 different companies. And some of the bigger companies we have a long-standing great relationship with. Like the biggest out there is Equity Trust. And I've done a lot of training for Equity Trust and still continue to do that because they've got a lot of people that are sitting on cash and they're looking for alternative investments. And at the moment, the shining star is notes versus what is more common in the market, right? And once again, it's all market timing. I'm
Right.
sure that your audience is very aware that commercial real estate isn't where it was, and you have to be a lot more careful in investing in syndications today than in the past. And rental houses are not making near the cap rate they used to. So if you're just saying, well, I can make an investment and earn a 4 or 5 cap in a real estate deal, and I can buy a note and a performing note, not problematic, just getting a check every month, and I can make 9 to 11, or I can buy a non-performing note and earn up in 18 to 25%. Notes are pretty favorable at the moment, and once again, notes do good when inflation and rates aren't good.
Right. Right. So along the terms of the money, who's a typical uh, student at your note school?
Somebody like you, somebody that's very savvy in real estate, but they're just diversifying their portfolio. They own 100 rentals, they own 500 rentals, they own apartments, they own different things. They're just diversifying. That's a third of Note School's audience is somebody that's in real estate and in the game and knows the game and just says, "Hey Eddie, you got 45 years, you got all this stuff, you got access to inventory. You can position me where I can go ride Note School's coattails and not have to go build a whole business doing this. Kind of done for you, so to speak." A third of them are people that are smaller investors. They have a rental portfolio. They're not happy. We show them how to convert their rental houses to seller financing, and then we show them how to take money also and then invest in notes. And a third of them are people that, quite honestly, have looked at investing in real estate and looked at stocks and bonds and looked at all those things, and they say, I want something that's easier than having rental properties, and I want something that has a little more control than a syndication.
Yeah, that seems like a pretty good fit then. And a little bit I know about the self-directed IRA is that the lending is one of the easiest opportunities from a self-directed IRA as opposed
Well,
to, or I mean,
that's
go
that's
ahead.
sold. I kind of disagree with how the industry has positioned that because uh, hard money lending is a business and it's a pretty sophisticated level of underwriting. Note buying takes a lot less sophistication, and you don't get paid off in 6 months. You get 6 months worth of payments and another 6 months and another 6 months. So it's a little easier to own a first mortgage on somebody's house that's a long-term mortgage than trying to go loan a real estate investor money so he can do his next fix and flip.
Right. And what I meant to say about that as far as just the opportunity for slip or get into a penalty phase of lending your money
Yeah.
or taking your IRA And if you lend it to a family member, or you go buy a piece of real estate with it, or all of that when there's a mortgage involved. Whereas if you're lending, it's pretty straightforward. It's um, you know there's an interest rate now, and I'm kind of curious, as I just said that, buying a note that's basically it's in the vessel of the IRA. The interest accrues when the note goes to foreclosure, or the property goes to foreclosure. The note gets paid off. That recharges your funds plus the rate of return, and then you basically go again. Is that kind of what you see? Is that the
It,
cycle?
it is. It is. People buy non-performing notes in their IRAs. It's people are more likely to buy performing notes in a self-directed retirement account. See, here's the thing about it. I've spent 45 years buying 50,000 notes. If you think about it like that, what I have done is I've taken real estate investors' assets, which are notes, long-term notes receivable, and I've showed them how to turn them into cash. Okay. In other words, they recapitalized. Well, that's what I show students how to do. I show them various techniques of how to go, not because once again, you would have a tendency to run out of money. You could only buy so many notes, and then you're spent out, right? But if you use recapitalizing techniques, and there's a number of those that we're extremely good at showing people, you can go sell the front end of the note and keep the back end of the note. You can take a 20-year note, sell 10 years, and then keep the back 10 years for your retirement account. But you might recoup 85 or 90% of what you paid for the note just to sell 10 years. So there's all kind of things that you can do at a different level that you start realizing, wait a minute, my retirement account can be its own little bank. And I kind of remind people of this. It's absolutely a truth. What's the tallest building in most every town?
A bank.
There must be something to it.
Yeah. Good business. Yeah, that or a casino, right? That's funny. Um, well, this is interesting. You know, typically my mind goes to thinking of notes as underwriting the borrower, the expectation of getting repaid. Seems like just based on the opportunity you've described with the amount, the volume of loans that are in default, the length of time they've been in default, seems like a very opportunistic time coming up here pretty quick. But I guess do you think it's going to be administrative decision that forces this, or how will this marketplace?
I think some of the powers that be at the federal agencies are going to change. I think those names are going to change on the door, and I think they're going to be a lot more like this has to get to resolution. It can't be good for the country, and it can't be good for these agencies to have loans that are hundreds and hundreds of days delinquent with no end in sight of how it's going to fix. That doesn't
Right.
seem like efficiency to me. That seems like bureaucracy.
Yeah. No, it's clearly well, you can't continue the fiction. I mean, eventually this is reality, and you've got to, they have to reconcile. And so sounds like
Let
we're
let
headed
me
there.
say this: do not disregard buying performing notes. If you have a rental portfolio and you're making a 4 cap, you can reposition how you deploy your next money, and you can make about a 10 cap on the same deal. That's 2.5 times the income. So don't disregard performing notes, right? And there is a gigantic growing amount of seller finance notes, and the reason is a lot of landlords are converting their rental properties to owner financing. And there's some very good economic advantages that we teach them how to do. But we're showing people how to make seller financing, that they wouldn't have considered. So we're triggering it because the market is it's easy to show somebody the math. In other words, I can't make up the math. The math just is what it is. But we're triggering the idea that it's possible. And now all of a sudden people are like, oh yeah, I want to go convert some of these. And now all of a sudden they've got inventory of notes to sell. So the here's what we really have at the moment. We have a big lift in availability of seller finance notes today, right now. And that's and with the economy in front of us, let me ask you a question. Are rents drastically going to go up?
I would expect they continue to go up. I mean,
I,
I don't know,
they're
how they
declining
can.
now. They're going the opposite direction.
Right, but that's always a supply and demand. I would assume that's based on a supply. It's supply and demand. I mean, if there's more demand, then it's going to go up. If there's less demand, and if you have a larger supply of people who can't pay, they're going to couple up or whatever, or
Yeah.
So there will be. I think that the long term trend is up, but in these cycles, you do have the supply and demand changes, and so yeah, you're right. I mean, you can't. Currently, it's very difficult to push the rents up that much.
Here's why we make a joke and say people are trying to eat an equity sandwich.
Yeah,
Your house doubled in value, but your rents didn't double,
right.
and your expenses went up at a way higher pace than your rents. And so for those mathematical reasons, this is why it produced an opportunity to say, hey, it's more profitable to be the bank on a rent house than it is to be the landlord, right? Because the bank can make a non-QM loan and earn 9 or 10% interest, and you got a house that's making 4. The bank's winning.
Right.
And so
Right.
why don't you just switch seats and figure out how to be the bank? And we're very good at helping people do that. And I don't mean at an unsophisticated level. We've got lots of clients that have hundreds of rentals and certainly know the math, and that's why they're converting. So there's an inventory of notes in the seller finance side being created, and it's very logical as to why it's true. On the non-performing side, if you ask me right at the moment, Eddie, go find me, you know, whatever, $40 million in non-performing notes. I'm not saying I couldn't make some phone calls, but I think at the moment there's a lot of anxious money looking for it, and it's probably a little overpriced. But we are going to see a big surge of inventory of non-performing notes in the next 18 months, way bigger than we've seen in a long time, way bigger than we've seen in a long time. And so that train is coming down the track, and we are saying we're also good at training people to do that too.
Got it. Got it. Hey, Eddie, if we could, I'd like to shift gears here for a second.
Yes, sir.
By day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be your uh, investors, could be the note market, could be the Fed rate, could be the political winds, whatever it is you identify and consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so, if you're willing, I'd like to ask you, Eddie Speed, what is the biggest risk?
Losing my money. And losing my money means that I bought a note and I don't get enough recovery to go pay off my investment and still make a yield. So that could be that could relate to non-performing notes, performing notes. It does everything down the line. It's like at the end of the day, that is why I like buying first mortgages with a cushion between what the collateral is worth and what I invested in the note. And that's the simplest form to say at the end of the day, that's my safety net. That cushion between what the collateral's worth and what my investment is in that note.
That's pretty straightforward. I mean, losing your money and how to avoid losing your money, that's pretty straightforward. I appreciate that.
Yeah.
Hey, Eddie, where can the listeners go if they'd like to learn more or connect with you?
Well, I figured before the podcast started today that we might stir up some interest and people saying, "Tell me more about that." Right? We covered a lot of ground. What I want to do is give them a master class, which is where we can slow down and put real deals on a chalkboard and model them out and show people the math, show people what that work. I've kind of introduced them to the idea of there's leveraging strategies. Like, what is that? How does that work? What does that look like? So there's some things that we kind of talked about today that are going to take a little more explanation. But I think once people see it, it makes sense for them to consider it. And so they're going to go to noteschool.com/CREPN. So we know they're from you. And it'll be a registration for about a 2-hour master class. And I think it will answer a lot of their questions. And a lot of people, it's a quick way for them to decide whether they want to learn more or not.
Awesome. That's great. Well, Eddie Speed, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Yes, sir. Thank you so much.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.